So, good evening, friends. Welcome to BNI Alliance Expo. Today, we have with us one of the finest minds in financial market, Mr. Nilesh Shah, a man who needs no introduction. Mr. Shah has had an illustrious career spanning over 25 years. He is a gold medalist chartered accountant and merit ranking cost accountant. Mr. Nilesh Shah is managing director of Kotak Mahindra AMC, managing well over 1.6 lakh crores. He is also currently chairman of AMFI and a member of Economic Advisory Council to Prime Minister. Thank you so much, Nilesh sir, for taking time out and being with us today. Thank you, sir. Welcome.
My pleasure.
Thank you, sir. Sir, in these turbulent times, एक general question ये है कि are we out of the woods as far as the equity markets are concerned? Because we have seen the crash happening in the month of March. And after that, there has been a V-shaped kind of recovery with Nifty touching almost 11,200 today. How can one explain this rise in equity markets?
So one, we cannot say that we are out of the woods. That we can say only when we have medical solution which will allow resumption of normal economic activities. Second, when markets moved from 12,000 Nifty to 7,600, the market cap to GDP ratio moved from somewhere around 79% all the way down to 51% against our historical average of about 73%. So from being relatively marginally overvalued, it became very, very cheap. Obviously, it needed to correct the equilibrium. As we speak, it is now trading at 74% market cap to GDP ratio, which is its historical average. More importantly, when we look at Nifty at 10,300 in the month of June and at 11,200, numbers will be almost similar. 15 stocks like Reliance, Lever, Nestle, Asian Paints, they pulled the index to almost 14,000 level. And the other 35 were at 7,500 level. So it is few stocks which is pulling the market up rather than broad-based rally.
Okay. So it's a very insightful statement, sir. So, sir, a follow-up question on that. Do you feel that markets might correct sometime soon once the Q2 results start pouring in, which they have started? And Q3 results also come in?
So typically market will correct if the actual scenario is worse than what is priced by the market today.
Okay.
And markets will rise if actual scenario is better than what is priced by the market today. At 11,200 Nifty, market is discounting that one, India will be current account surplus, low gold import, low oil price, and reduction in trade deficit with China because of boycott of Chinese products. Market is discounting that medical solution is around the corner, that's driven by 8 vaccines which are in phase 2 trial, transiting into phase 3 trial. Market is also discounting that the economic package announced by government and RBI will work on the ground and it will restrict GDP degrowth to about 5% in FY21. But at the same time, boost GDP to 8 to 10% GDP growth in FY22. Now, these are broad assumptions of market. If actual scenario is better than what is priced by the market, markets will rise. If actual scenario is worse than what is priced by the market, markets will fall. I wouldn't dare to guess whether markets will go up or come down. All I can say is that markets will fluctuate.
Fair point, sir. So we also saw a lot of FII selling in the month of March. And there was a talk going on that there will be some kind of MSCI index re-rating, India's weightage being re-rated. So what is the status as of today on that? And
so
do you see FII funds flowing in?
I do see FPI flows coming into the market. MSCI announced earlier in first week of April that they will increase India's weightages and they will announce it by 30th June. In the last week of June, they announced that they are waiting for certain data and thereafter they will take the decision. it is quite certain that MSCI will increase India's weightages by about 8%. And FTSE, which is equivalent of MSCI on the other side, they have already announced increase in India's weightage between 7 to 17% on September 20, December 20, March 21, and June 21 in a calibrated manner. With both benchmark indices agency increasing India's weight, it will be fair to expect that there will be FPI flows in Indian market.
Thank you, sir. Thank you for that insight. So, sir, again, on equity markets only, so many clients are feeling that the SIP returns of last 3, 4, 5 years are not as per expectation. So we have a lot of concerns on that point. So what would be an advice to all those kind of investors who are having SIP for 3 years, 4 years, or 5 years? What would be our advice to them?
So I'll just give data from my own existing equity fund, Kotak Emerging Equity. When markets were touching 12,000 in Jan, 1 year SIP return of Kotak Emerging Equity was 27% and 10-year was 17%. In the March, this number crashed. From plus 27 on 1 year SIP, it became minus 41%. And from plus 17 on a 10-year, it became only 9%. Obviously, in a bear market, when you calculate SIP return, it looks disastrous. In the month of June, markets have recovered a little bit. 1 year SIP return is still negative at 6%, but it is no longer minus 41%. And the 10-year SIP returns are up to 12%. If you continue your SIP when the markets are cheaper, when the SIP returns are negative, I'm sure when markets recover, you'll make maximum money on those SIPs. All of us have to learn how to look at the future. And one thumb rule is that when SIP returns are poor or negative, that's the best time to increase your SIP.
Right.
And when SIP returns are very good looking, then that's the best time to reduce your SIP.
That's right, sir. That's right. So it would be so the basic rule remains that whosoever are in this market in SIP, please have a long-term view, have a 7-year, 10-year view, and continue your SIP.
See, essentially, when we say 5-year, 7-year, 10-year for long-term, we are implying that you have to move from a bear market cycle to bull market cycle.
Right.
Markets will go up and down. 2013 was a bear market. With the benefit of hindsight, we know 2018 was a peak of the bull market. Now we are entering back into the bear market, and hopefully March 20 will be the bottom of the bear market, unless until something goes wrong on medical side. Okay. So compare returns from a bear market to bull market, not from a bull market to bear market.
Okay. So thank you for the insights on all these markets, equity markets. So moving on from equity to say interest rates in last few months have gone down drastically. So what's your take on this? How do you see the interest rate panning out in next 6 months, 12 months time?
Our feeling is that as inflation comes under control, RBI will exercise their space to cut policy rates.
Okay.
They have cut policy rates quite aggressively in last 6 months, going out of turn. Now they will be calibrated in their approach. More importantly, with so much liquidity in banking system, it is quite likely that interest rates will remain subdued and soft. The play is no more on policy rates alone. The play is more in credit spreads as well as medium to long term. With huge liquidity, short-term rates have come down, but medium to long has not fallen as much as they should have fallen. We believe RBI and government will work actively together to allay the market fears on overborrowing or high fiscal deficit resulting into excess borrowing. And this will allow medium to long-term rates also to come down. So we are looking for a slow and steady reduction in interest rates in a calibrated manner, little less on the policy side, but far more on the credit spread and medium to long end.
Right, sir. So for an investor, say 1 year or 2 year, 3 year horizon, credit risk kind of fund would be advisable, and a medium to short duration.
Undoubtedly, credit risk fund at this point of time is advisable, provided you can take one or two credit event.
Okay.
What happens is that when credit event happens, a delay or default happens, we have to immediately do markdown. But you can always exercise your security and recover the money. If investors are going to react looking at the markdown and not wait for the recovery, this is obviously going to create nightmare for them as well as us.
True. True.
If you see in the month of April, there was surge in redemption in credit risk fund. We were forced to sell our papers in a market where everyone knew our side of the trade because of our redemptions. They always knew that we were coming to sell. And this resulted into negative returns for credit risk funds in the month of April as credit spreads widened. In the month of May and June, credit spreads compressed because we were not desperate seller anymore. And the funds delivered between 2.5% to 3.5% absolute return. So when you are investing in credit risk fund, please take a 3-year view. Be ready for some credit events. We will try our best to avoid the landmines. But in case it is blown, there will be temporary losses, but with structuring and with recovery, your losses could be covered.
So thank you. Thank you for this take on debt funds and interest rate scenario. So moving on, I would also like to touch a little bit on gold. So with clients are showing a lot of interest in gold. So and with gold trading at its highest ever prices, how do you think, Amara, do you think one should take a leap of faith and invest into gold today?
Undoubtedly, we are recommending overweight gold. We started recommending overweight gold somewhere in February 2020. This was driven by the fact that in the world where interest rates are low and liquidity is high, gold prices generally remain higher. In 2008 beginning, gold was at $1,000. It crashed to $750 by November 2008 because of subprime crisis. And then it recovered to $1,900 by September 11 when interest rates were low and liquidity was very, very high. Almost similar scenario is playing out in 2020 and beyond, where low interest rates and high liquidity will ensure that gold prices remain supported. My recommendation to investors is that do remember that gold has a 12.5% import duty. So you are paying 12.5% extra price in India when you are buying gold. And the best way to invest will be via sovereign gold bonds. This gold bonds give you 2.5% coupon for a 7-year maturity that broadly takes care of your import duty. And hopefully over 7 years, gold prices, if they follow the trend of 2008 to 2011, could be higher than current level.
Okay. Right, sir. Thank you. Thank you for that. So we'll come to the last question. Also, I would like to ask you, is there a thumb rule for identifying someone's asset allocation?
There are various thumb rules which one can use. So one is to define what should be your risk allocation. So 100 minus your age should be your allocation into risk assets. So you are 30 years of age, you could put 70% in riskier assets and 30% in conservative assets. Fixed income, in India's context, government securities, small savings instruments are considered conservative assets. Real estate, gold, equity are considered risky assets. So you must decide what is your risk profile at various age level and then take a call how much to invest in safe assets, how much to invest in risky assets.
Right, sir.
The second thumb rule is that when everyone else is selling, you should be a buyer. And when everyone else is a buyer, you should be a seller. This is very easy to say, but very difficult to execute. But I'll give you a very small example how you can use this in the context of equity. People say you have to look at equity valuation to invest. At cheap valuation, you should be overweight. At expensive valuation, you should be underweight. But how does a common man find what is cheap, what is expensive? I'll give example on Kotak Balance Advantage Fund. This is one fund where we can invest between 20 to 80% in equity. If the fund is invested between 60 to 80% in equity, we know we are super bullish and valuations are cheaper. If it's between 40 to 60%, you know we are optimistic on market, but on a neutral basis, it's fair value. And if it's 20 to 40%, you know we are bearish on market and valuations have become expensive. Now, if you use this model to decide your allocation, that Kotak Balance Advantage Fund is between 40 to 60, I'll be neutral weight to equity. When they are 60 to 80, I will be overweight. And when they are 20 to 40, I will be underweight. Very simple thumb rule. Let's put this into context in last 6 months. At about 12,000 Nifty, when it was trading marginally above its historical average, we were roughly around 40-45% band. So we were not underweight equity, but we were somewhere nearer to becoming underweight equity at that point of time. When it touched 7,600, we were at 80% equity allocation, maximum possible. Today, as we speak, we are probably at 50 to 55% allocation. 60 to 65% allocation.
Okay.
Now, did we become 80% at 7,600? Certainly no. We would have become 80% at 8,500 also. Did we become somewhere around 40%, 45% at 12,000? Certainly no. We would have become from 11,500 also. So you can never capture the top and bottom of the market, but you can define a range that this is cheap, this is expensive, I will be overweight here, I'll be underweight here.
Right.
And you can simply look at Kotak Balance Advantage Fund equity allocation to decide what is your correct equity allocation. The same strategy can be followed on gold, same strategy can be followed on real estate, same strategy can be followed on fixed income. At this point of time, my recommendation will be neutral weight equity and fixed income, be overweight gold, and be underweight commercial real estate.
Right, sir. So thank you very much. Thank you very much for the wonderful insights on each and every aspect of financial transactions in the country today. So thank you so very much for giving us your time, and thank you for being here, sir.
Thank you, and wish all the very best to you, the listeners.